For more on how to position ahead of Trump's second term, let's bring in Kevin Nicholson, partner and global fixed income CIO at RiverFront Investment Group. Kevin, welcome. Good to have you with us.
Thanks for having me.
And we'll bring Chris into the conversation as well. On the market, you heard what President-elect Trump said. He expects the economy to be good, America to be great again, and markets to keep on moving up, but doesn't discount the possibility of a dip. Do you see 2025 as potentially a year with lower returns than we've become accustomed to over these past couple of years, in part because some of those returns have been pulled forward into 2024?
Tyler, I definitely think that is the case. For the last couple of years, we've had very robust markets. And going into next year, our base case is that the S&P will be up somewhere between 4.5% and 6%. That being said, that'll take you, depending on where we end the year, that'll take you somewhere close to about between 6,350 and 6,500.
So, Chris, let me get your reaction to that. And I think you're kind of singing from the same hymnal here.
Yeah, I may even be a touch more conservative than Kevin. I think both Kevin and I looked at Kevin's notes, and we're both forecasting 15% earnings growth for the S&P next year, and that's kind of consensus. But that's pretty high considering we're at record margins. And Kevin, what do you think about the economy next year? I mean, 15% is about as good as it gets. What's the downside from that kind of projection, and especially when we're about 25 times earnings on the S&P?
The biggest thing that we have to worry about, I think the markets have possibly gotten a little bit ahead of itself, largely because of people are pricing in deregulation of markets next year, as well as the potential of corporate tax cuts. And while all of that is good, the part that could potentially hurt us is that tariffs will be the deciding factor of how good corporate earnings are next year. And if tariffs are too high and generate inflation, that could be the downside that we see in the economy, and start seeing a pullback in financial markets as well.
Chris, run us through in the portfolio, what are kind of the maybe 5 or 10 or 12 major positions that you're holding into next year?
Well, Kelly, as I mentioned, I'm pretty conservative on the market here. So we're trying desperately to find some value. Healthcare is about as cheap as it's been against the S&P in 25 years. So we're almost doubly weighted in healthcare right now. So, yeah, and it's doing us no good at all.
Exactly. That's why I say.
But if we don't have 15% in earnings growth, or if the market's not up another 30% last year, like it's been for the last couple of years, then healthcare ought to be at least a decent performer and probably a nice outperformer in that kind of environment.
What gives you the confidence to be conservative, right? Because if you're wrong, this could be another 20% year that we're chasing things down.
Right. So I'll underperform in a year like that if we have another way above average year. But what I'm planning on is I'm okay underperforming in a strongly up market. I don't want to lose my clients a whole lot of money if we just revert to the norm, which is 16 to 18 times earnings. That's a 30% downturn from here. So that's the kind of mindset I'm having here.
Kevin, walk us through what you've been doing in your portfolios, both fixed income and equity. What kind of moves have you been making in the last 60 days?
So for our more equity-centric portfolios, we have been trying to position a little bit, get some more cyclicality in the portfolio. So we have, bought financials, added some industrials to the portfolios, but we've also added a little bit of small caps. Now, I say a little bit. We have dipped our toe into the market because we know that rotation may not, from growth to value, may not occur right away. We have to see where policy goes in 2025, and that is where the fiscal policy goes, and that will determine whether or not that rotation will happen. In our shorter time horizon portfolios, we have been more focused on, and these are the balanced portfolios, we've been more focused on thinking about generating income, and we've been doing that by starting to think about ways that we can rotate into fixed income markets. So from a fixed income standpoint, we think that yields are going to be moving higher into next year. And so we're focused more on the short end of the curve, basically in that 3 to 5 year range, because at this point, you're not getting paid to extend out to.
Explain the thinking there. Yields are going to be moving higher in an environment where most people, and I believe including you, think the Fed is going to continue to cut interest rates. And you'd think that would reduce yield.
Well, it will reduce rates on the front end, but I think that we're going to have a bifurcated market where the long end is actually going to go higher. And with that, that's the reason we've been kind of hanging out on the front end. And as rates go higher, we will look to fill in the belly of the curve, that 10-year part of the yield curve. And just to be clear, from a Fed standpoint, while we think the Fed's going to lower rates, we do think that they're going to be slower to lower. And so when we think about 2025, we're thinking that they'll be at 3 7/8 by the end of the year.
Slower to lower. And look at rates today, Chris. They're sticky. Everyone except the Fed seems to think that things are going to be a little bit stickier.
I'm with Kevin. I think we're finally going to get a positively sloped yield curve, but not for the good news that short rates are going to go to 2, but for the bad news that long rates are going to go a little bit higher.
Wow. All right.
All right. Kevin Nicholson, Chris Grisanti, sticking around for the whole hour. Kevin, thank you. Have a good holiday.